remember when silver first moved above $30 an ounce, I was telling people that 30 is the new floor, that 30 on silver was like 2,000 in gold. And I was telling people when gold was at 2,000 and they were afraid to buy it because they thought it was the peak, I said, no, 2,000 is the new floor. So buying 2,000, 2,100, you're getting in near the bottom. People were afraid it was the top. I kept saying that this is a new day. This is a big bull market. You got to buy this level. And sure enough, we're almost 3,500. We're going a lot higher. Same thing with silver. Silver was 31, 32. I kept telling people, you got to buy it. It's not going to go much below 30 if it even goes below 30. So you're getting in close to the bottom.
Breaking developments in global markets are fueling intense debate as the US dollar faces mounting pressure from soaring debt, persistent inflation, and weakening international confidence. Central banks across the world are steadily reducing their reliance on US Treasuries while increasing their stockpiles of hard assets, particularly gold. Economist Peter Schiff warns that these shifts are not isolated moves, but part of a long-term structural change, signaling that the era of unchallenged dollar dominance may be nearing its end. He argues that the financial system is approaching a critical tipping point where paper currencies will be exposed for their fragility, forcing investors to reevaluate where real value lies. Schiff maintains that while gold has always served as the ultimate store of wealth, silver may prove to be the most explosive asset in the years ahead. Its dual role as both a historical monetary standard and a critical industrial metal positions it uniquely for the unfolding economic transformation. He notes that in previous financial crises, silver consistently outperformed gold in percentage terms once momentum took hold, and this cycle may be no different. With analysts projecting scenarios where silver could surge dramatically, alongside forecasts of gold potentially climbing toward the $10,000 mark, Schiff emphasizes that hesitation could be costly for investors. Once confidence in fiat currencies begins to unravel, precious metals are likely to undergo swift and dramatic revaluations that leave little room for latecomers. According to Schiff, the relentless expansion of government deficits and central bank interventions have created unsustainable distortions in the economy, making a precious metals reset all but inevitable. Gold will likely continue to serve as the foundation of global wealth preservation, but silver could be the real surprise, delivering outsized gains to those who positioned early. He warns that the real question is not whether gold and silver will reprice higher, but whether investors are prepared before the market makes that adjustment for them. With gold's path potentially stretching toward $10,000 and silver poised for an equally historic breakout, Schiff's message is clear: the clock is ticking, and those who delay may soon find themselves shut out of the very assets designed to protect against this unfolding monetary storm. Before we dive into Peter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
The gold stocks, again, as I mentioned on my podcast 2 weeks ago, continue to lead the way now. They're not being dragged behind like they were reluctantly, with investors completely skeptical of the gold bull and expecting it to die any day. Now the gold stocks are leading. In fact, as of, I think, this week, gold was down about 2% during a time period where gold stocks were up 20%. Gold was just consolidating while the gold mining stocks were catching up. That's why I was hammering the table back in April, May of this year about buying the gold stocks, that was the best place to buy gold was in the ground because these stocks hadn't even moved yet. Well, now they're moving. And in fact, the GDX, which is the larger gold mining stocks, is now up over 87% on the year. This is shaping up to be the best year maybe ever. I mean, I guess if you went back to the 1970s, I don't know if this index, I don't think it existed back then. This is certainly the best year in the history of this ETF, and the year's not even over yet. I mean, I think that gold stocks are going to more than double as a group, which means some stocks obviously do a lot better than that if the average is a double. But right now they're up 86%, excuse me. It's the GDXJ, the juniors, that's up over 87% so far on the year. So these stocks are making a big move. The year-to-date gain on gold is now 32%. Gold is having a phenomenal year. Silver up 38%. But I think once we get above 40, we're going to make a beeline for 50. And then, as Katie barred the door once we're above 50. So don't wait. I've been hammering everybody on my podcast, on my X feed. I've been telling the guys at Schiff Gold, get on the phone, talk to your clients. They got to buy more gold and silver. And what I've been getting as feedback is that the clients have been reluctant to buy because they're worried about buying the top and they want to wait for a pullback. And I've been saying, don't wait for any pullback. You're not going to get any meaningful pullbacks. You just got to buy. Yes, you're buying the highs, but you're going to have to buy the highs or you're not going to buy. And the problem is the highs are going to keep getting higher. And so the longer you wait, the higher the high you're going to buy. So don't wait. In fact, remember when silver first moved above $30 an ounce, I was telling people that 30 is the new floor, that 30 on silver was like 2,000 in gold. And I was telling people when gold was at 2,000 and they were afraid to buy it because they thought it was the peak, I said, no, 2,000 is the new floor. So buying 2,000, 2,100, you're getting in near the bottom. People were afraid it was the top. I kept saying that this is a new day. This is a big bull market. You got to buy this level. And sure enough, we're almost 3,500. We're going a lot higher. Same thing with silver. Silver was 31, 32. I kept telling people, you got to buy it. It's not going to go much below 30 if it even goes below 30. So you're getting in close to the bottom. Now here we are knocking on the door of 40. Don't wait for 50. Yes, would it have been better if you bought it a couple of weeks ago? Sure. I tried to get you to buy it a couple of weeks ago. But if you didn't do it then, do it now, right? Why buy 50 when you could buy 40? And the move from 40 to 50, that's still a 20% gain. You buy $40 silver at $50, you got 20%. But 50 isn't going to be the top. It's nowhere near the top. In fact, I think once we get through 50, 50 will be the new 30. 50 is going to be the support for silver. You'll be lucky to be able to buy silver below 50. Right now, it's a double top from 1980 and 2011. That resistance is going to become support, just like $2,000 was the resistance in gold. From 2011 to 2024, it was resistance. It then became support, right? Resistance becomes support in bull markets. So we're going to blow through that double top, and 50 is going to be the new floor for silver. So get in now while it's a lot cheaper. Now, what is driving this? Why are gold prices, why are silver prices moving, right? For the reasons that I've been laying out for years now, but it's playing out right before your eyes on this giant stage. Look at what the Trump administration is doing to the Federal Reserve. I mean, up until now, they've at least had the pretense that the Fed was independent. Now, I've said that this was all BS, that there was no real independence, that behind the scenes, they were working hand in glove. Well, Trump dropped the pretense. He is now making it obvious to everybody that the Fed is political. He is stacking the Fed with his own cronies. He is coming up with dirt on people so he can fire them, so he can replace them with his own cronies. And he wants to move interest rates down. Why does he want to move interest rates down? He tells you, because we can't afford the rates. He says the U.S. government needs to save money. We need to cut back on our interest expense. He says the housing market can't handle these high mortgages. We need lower interest rates so people can afford to buy houses, right? So we're too broke for the interest rates that we have now, except the interest rates that we have now are low. They're just not as low as they used to be. And because we have so much debt, we need those super low interest rates.
Tariffs are quickly becoming a defining issue for the U.S. economy, and many economists warn the implications extend far beyond higher consumer prices. Under the Trump administration, tariff levels have risen sharply, eliminating previous exemptions and directly impacting everyday shoppers who now face added costs, even on small imported purchases. While tariffs are often promoted as a tool to bring back domestic manufacturing and jobs, Peter Schiff and other critics argue that the policy misdiagnoses the problem. Instead of addressing the deeper structural issues, such as burdensome regulations, high labor costs, and an overvalued dollar, tariffs simply act as a tax on American consumers and businesses. In many cases, U.S. manufacturers themselves rely on imported components, which now come with higher costs, making them less competitive both at home and abroad. Ultimately, this raises prices, reduces demand, and weakens the very industries tariffs are meant to protect. The broader concern, Schiff emphasizes, is that tariffs are masking rather than solving the underlying economic imbalances. He compares them to a band-aid on cancer, pointing out that America's chronic trade deficits stem from policy failures at home, not from foreign cheating. As a result, tariffs may temporarily boost sectors like steel or aluminum, but over time they squeeze downstream industries that rely on those materials, leading to layoffs, closures, and reduced global competitiveness. Combined with soaring deficits, stubborn inflation, and a weakening economy, tariffs risk worsening the next inevitable bust. One Schiff warns could be far more severe than 2008, with debt-fueled bubbles expanding and the Fed likely resorting to renewed money printing to paper over the cracks. The short-term sugar high of tariffs may give way to a deeper crisis of defaults, bankruptcies, and market collapses.
Even if gold stays where it is, these gold stocks are cheap. Investors have been afraid that gold was going to crash, and so they stayed away from these stocks. Now I think they're coming to the realization that gold's not going to crash. It's the dollar that's probably going to crash. So they're buying these stocks, but they still haven't accepted the reality that the gold price is going much, much higher. And again, so will the silver price. Once they accept that reality, then they're really going to get aggressive in the buying of these stocks. But one of the kind of negatives of the gold bull market was the failure of the gold mining stocks to confirm the bull market. I've been hearing this for years, that this lack of confirmation shows that the gold market bull is running out of steam, because the thought process was the stock market investor is forward looking. So the stock market investor is not looking at today's price of gold, but at the future price of gold, and using that future price to discount the expected earnings of the gold mining companies. So the fact that the gold stocks were weak meant that investors expected that gold price to go down. And so you had this negative sentiment. Now, what I was saying all along is, well, you know what? I think that's bullish, because it shows that there's no confidence in this bull market, so it's going to keep on running. And it's been doing that the whole time. The gold has been going up. Gold's been going up for 25 years. Gold's done better than the S&P 500. Just buying an ounce of gold and hiding it in your underwear drawer, I think it's about a 9% or so compounded return for 25 years. I mean, it's better than the S&P 500, even if you reinvested your dividends over that same period of time. And gold is just a metal. So the whole time gold's been going up, the gold stock investors have been saying that it's not going to stay up. It's going to come down. It's a bubble. It's all short term. It's because of this or because of that, but it's going to come down. Now investors are starting to wake up that this rally is real. Now that doesn't mean it's anywhere near over, because we still have the majority of institutional investors to realize this. We've just got a small group of people realizing that this has happened. If you look at gold and silver and mining equities as a percentage of what typical investors have, I think it's about 0.5% of all the investment capital in the U.S. is allocated to gold, silver, and mining stocks, against a historic average of about 2%. But the reason that the average is so low is because most people have no exposure. Most institutions have no exposure, because I think the people that understand the gold story have a lot more than 2%. They may have 10 or 20%. Look at me, I'm like 60%, right? So there are a lot of people who get it that are way overweighted. So that's the reason it's 0.5%. It's because so many other institutions and individuals have zero weighting. They don't own an ounce of gold or silver. They don't own a share of a gold or silver mining stock. And that means there is a tidal wave of buying that is going to come into this market. And it doesn't take much to lift it. But just to revert to the mean of 2% of the assets in the precious metals, physical and mining, would mean a fourfold increase in demand, which is not going to be met by an increase in supply, not even close. So this is just early. Eventually, sure, there will be rampant enthusiasm among individual retail investors, but we're not even close to any kind of euphoric blow-off. It's nothing like the enthusiasm that you see in crypto and Bitcoin. And by the way, Bitcoin year to date is only up about 15%. So that's half the gain of silver or of gold, and even less when compared to silver. Yet gold and silver didn't get anywhere near the hype that Bitcoin got. Bitcoin got all the help from the Trump administration, all these new Bitcoin treasury companies buying up Bitcoin. And despite all that buy-in, you only have a 15% gain, which could evaporate very quickly. Whereas the real money is being made in gold and silver, it's been mainly driven by the central banks, because the central banks don't like what the Fed is doing either. They don't want to hold dollars as a reserve if the Trump administration is going to compromise what's left of the pretense of Fed independence and lower interest rates and offer a yield on U.S. Treasuries that is lower than the rate of inflation, that is much lower than the rate of dollar depreciation. Why do our creditors want to lose money? Why do they want to accept an interest rate that doesn't even cover their annual loss due to the foreign exchange, let alone what it's doing to the underlying value of the principal that they would get paid back? So foreign central banks are moving out of U.S. dollar reserves and into gold. And more central banks that haven't done that yet are going to be joining the get out of the dollar parade. And right now, central banks have been walking away from the dollar. But as the dollar's decline accelerates and gold's rise accelerates, they're going to run from the dollar and they're going to run to gold, because that's where you go. No, for years, when I was warning about the dollar's days as the world's reserve currency being numbered, people always said, well, Peter, there's no alternative to the dollar.
The outlook for gold and silver points toward a future where both metals could become central to the next major financial revaluation. Gold, long regarded as the ultimate safe haven, is poised to benefit from rising geopolitical tensions, persistent inflationary pressures, and the growing distrust in fiat currencies. Central banks across emerging and developed markets continue to build their reserves, signaling a shift away from reliance on the US dollar and reinforcing gold's position as a cornerstone of monetary stability. Each time confidence in traditional financial systems weakens, gold emerges stronger, suggesting that its trajectory toward new historic highs is far from over. Silver, meanwhile, carries the potential to deliver even more dramatic gains. Its unique dual role, as both a precious metal and an industrial necessity, makes it a key player in two powerful narratives: financial hedging and technological advancement. With surging demand tied to solar panels, electric vehicles, and expanding global infrastructure, silver is becoming increasingly indispensable to the green energy revolution. If physical silver truly becomes the linchpin in a monetary transition, will investors recognize the warning signs in time? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.